Welcome to Russell's Investment Perspectives. I'm Mark Supasay, and this month I welcome back Jeff Hussey, the Global Chief Investment Officer here at Russell. Jeff, thank you for being with me today.
Thank you.
It's good to have you back. About a year ago, we had you on the program. We talked about investment strategy, and I thought it would be good to have you back again to look at 2014 and also look ahead to 2015. And so with that, let's begin with a bit of a recap. As you look back on 2014, how did what happened in the markets compare with what your expectations were?
Well, 2014 wasn't without its share of surprises, but I do think that we got the call right on equities. We were positive on equities based on three key inputs to our process. First, cycle, where are we at in the business cycle, knowing that certain securities do well in different parts of the market cycle. Secondly, valuation. We want to buy things low and sell high. And sentiment was the third one. What's the mood of the market? What is the consensus? And do we agree with that, or do we want to be contrarian? We came into the year believing that we were in a good part of the cycle. We're sort of in a mid-cycle. That's positive for equities. From a valuation perspective, we recognized things were fair to slightly rich, but the sentiment also was constructive for us to have a positive view. That is, the masses and the investors out there still seem to have a healthy skepticism about investing in equity markets, still a little jaded from the global financial crisis, and still hesitant in investing in equities.
Sure. So at the beginning of that answer, you used the word surprises. What was the biggest surprise that stands out for you from 2014 in the markets?
Well, for the community at large, I think it was all about bonds being the biggest surprise. Nobody really anticipated such sluggish growth in Europe. Nobody really anticipated yields on German 10-year bonds would fall below 0.8% on the 10-year. Nobody really expected that to bleed into the U.S. markets, and really, despite good payroll growth, despite good economic news, yields declined.
You mentioned the entire community missed it, so consensus estimates, I assume, were way off. What did that mean for the markets then? So
according to Bloomberg data, the 10-year started at a little over 3%. As the year went by, actually yields fell down to 2.2%. The expectation for the year was that yields would end at 3.2 to 3.4%, so quite a big difference.
How does a portfolio manager adapt in a changing market environment like that? And in particular, what is the implication and the opportunity for active management in your view?
Our investment team is in the markets every day. Our strategists are focused on corporate earnings, economic announcements, changes in fiscal monetary policy, geopolitical events, all centered on trying to forecast what the market's going to do in the future. Our portfolio managers also hire some of the best and brightest sub-advisors in the world, and they have some unique insights that also come into Russell's overall view and forecast for the market environment. I mean, at the end of the day, Russell's active management process is about a discipline. It's not about a product.
What does that mean then for 2015?
A couple of things are weighing on our mind as we look at 2015. The first is central bank policy divergence. And by that I mean the U.S. Federal Reserve and Great Britain are both on a path toward normalization in terms of interest rates. That's contrasted with Japan, Europe, and even China in terms of the amount of stimulus that they continue to put into the system. We think that policy divergence is going to create pretty high volatility, or higher than what we've seen, which has been a pretty low volatility environment. That will create opportunities for us to be able to generate some extra return for clients. The third thing weighing on our mind is really just sort of market valuations. Emerging markets are very cheap relative to some other areas. They've had 2 consecutive years of pretty negative returns. We also see pretty big price divergence between what the market thinks and what the Fed has signaled it's going to do in terms of interest rate increases. Anytime there's big divergences in views, we think that sets up a good opportunity for Russell to add value for its clients.
So what does this environment that you're describing mean for global equities versus fixed income, and then for risk assets overall?
Broadly, we continue to have a constructive view on equities, particularly relative to bonds. We recognize valuations have increased as market returns have been strong, but we also think we're still in a good part of the cycle for equity returns to do well. Sentiment is also turning a little bit. People are becoming a little bit more confident in the equity market, but not too confident. Warren Buffett has a famous quote that says, "Be fearful when others are greedy, be greedy when others are fearful." And while people haven't turned from being super fearful to greedy, they have turned from being super fearful to maybe more constructive. And we think that still puts us in a good place to forecast positive returns in 2015 in equities.
What does that mean that equities are constructive? That's a term that I don't hear a lot. What does that mean exactly?
Yeah, generally it means somewhere between neutral and outright overweight. I'd say we're modestly overweight. We're expecting a 6 to 8% return. But there's a huge margin of error in that forecast given the volatility we see in equity markets.
What about fixed income? Talk about that. What's really top of mind for the year ahead in fixed income?
Sure, we do expect rates to rise this year. That bodes for sort of flattish returns in fixed income. Within high yield and emerging markets, some of the risky areas, we're still actually quite constructive. We do see defaults ticking up, but ultimately there's some good value there.
So just summarize your outlook for 2015 with a few choice phrases.
Sure. I think the only certainty in life is uncertainty. To deal with uncertainty, investors need to have a couple things in place. First, they need to be able to ride out the volatility in markets by having a sound strategic asset allocation. And we do think that diversification is the closest thing to a free lunch. So stay diversified, have a globally asset allocated portfolio that makes sense. Second, this is going to be a market full of surprises if you haven't heard that through the discussion here. We think it makes eminent sense to have a dynamic plan in place, have an opportunity to be able to capture some of those opportunities that are going to happen in the market in 2015. Certainly 2015 would argue for those two elements to be a key component to investors' portfolios.
All right, Jeff, you've given us some helpful context today. Appreciate your time. Thank you for joining us on Investment Perspectives, and thank you for being with us for this episode. We'll see you next time.